95% of traders only focus on chart reading or deltas, hoping to make money. But ignoring this one Greek option can make your account go red, even if you get the stock direction correct. I have saved tens of thousands of dollars over 1,000 trades since 2018 just by controlling Vega risk. In this lesson, I'll help you prevent future losses by understanding Vega and how to manage it. The symbol for Vega is just a V. This is what you'll see in the platform in most brokerages. Vega measures the sensitivity of an option price to 1% change in implied volatility. Let's look at some examples right here. Your option pricing is $1, and if your Vega is 25 cents, okay? If IV increases $1, then your option pricing will now become 125. Okay, that is if you have positive Vega. Okay, and if IV drops by 1 point, by 1%, then your option pricing is now only worth 75 cents. Okay, so let's go over an example that's a bit more expensive. So something is worth 10 bucks. Okay, Vega is 75 cents. For each IV increase, each percentage increase, your option pricing will increase by 75 cents. So in this case, it will become 10.75, okay? And if IV drops by 1%, 1 point, then it will become 9.25, okay? Even if all things remain the same, the stock didn't go up or down, just by increasing or decreasing the IV, your option pricing will change. When does IV change? Okay, let me give you an example. When the stock crashes, usually IV will increase, okay? And usually it's not by just 1 point, it can be by a few points, okay? And when a stock goes up, usually it means the uncertainty is lower now and people are less fearful, so the IV will decrease. That's when this happens. The next thing we need to go over is Portfolio Vega. What Portfolio Vega means is it is the sensitivity of your entire options portfolio to changes in IV. When we're talking about this IV at a portfolio level, we're talking about the VIX. So let's say our Portfolio Vega is negative 500 right now. We do not want the VIX to increase, because if VIX increased 10 points, then 10 times 500 is $5,000. That's $5,000 loss if the VIX pops by 10 points. Now, vice versa, if the VIX drops 10 points, 10%, our portfolio will make 10 times 500 Vega, $5,000 if we're short Vega. Okay? All right. There's 3 characteristics to Vega that are very important that we need to know, okay? Long versus short options. Long options carry positive Vega. They gain value as IV rises. So how do we use that? Usually, people that long put options, people that are betting that the stock market will go down, will benefit from this, because put options, you make money from direction when the stock goes down, okay? And also when the stock goes down, the IV increases at the same time. So you're getting both the direction correct, and also Vega will boost the value of your option, okay? However, we are usually short option sellers and we want to carry negative Vega. So what that means is we benefit when the IV falls. That's why we open our short strangle trades, our short put trades when IV is relatively high. That's why we say when we want the IV rank to be above 30 at least. We want medium volatility. Why? At medium volatility, our option will be worth more when we sell the option, okay? If the stock go up, then that's perfect because we got the direction right, and we also have the IV going down. So that will make the option pricing cheaper. So when we buy back, it's going to be good. So we're playing both Vega and deltas on these short option trades. Okay. The second thing we need to know about Vega is at the money strikes have higher Vega. okay, at the money strikes. So as we go out along the option chain, the out of the money side and in the money side, those strikes carry less Vega. I'll show you an example of that in Tasty Trade in a little bit when we look at the option chain. Okay, and the third important characteristics about Vega is Vega grows with time. What does that mean? Longer dated options have higher Vega. So a 60-day DTE contract will have higher Vega than a 30-day DTE contract, okay? So the more time expiration you have, it means the more opportunity for volatility to move and change the options value. So now we know that. How can we use this in practice? First thing is, when we're in low volatility regime, okay, we should have less short Vega exposure. Why? Because there's a chance for the market to crash and for IV to expand, okay, which hurts our short premium positions. These hurt short puts, these hurt short strangles, these can also hurt anything that has short Vega exposure. Even credit spreads a lot of time have it. Short calls also gets hurt from IV expansion. So keep it in control. I'll talk about some good practices of how much short Vega to have in a bit. The second thing is, on the opposite end, during high volatility regimes, we benefit from IV crush and mean inversion of volatility. So when the IV is high, when the VIX is high, when the market is crashing, when CNN fear index says extreme fear, that's when we should be aggressive and sell more options, okay? We should be benefiting from this elevated IV because volatility always mean reverse, back to normal after a while. Once the fear subsides, IV will drop quite fast. And because we are short Vega, that will help our positions and we can buy back our short options easily. Far dated contracts. So during corrections, during market crashes, the volatility will be high and we want to have higher short Vega exposure. So we'll sell further dated options because they carry more Vega. So what that means is we're gonna sell usually 60 days or even 60 days plus, okay, instead of 30 days or 45 days. We want more time. We want more Vega, okay? So we go for the further dated contracts. So key takeaway, Vega is not static and it shifts with the market. It shifts with the volatility, it shifts with the strike, it shifts with the time, okay? Controlling Vega exposure based on the market regime is very important. So a good practice is to keep 1% of your net lick in negative Vega. So if I pull up a calculator here, so if we have a $100,000 account, we want to have about 0.1% of negative Vega. So 1,000 short Vega. That's a good practice. It's not set in stone. It's just a general idea. So you can look at your account and tell, oh, do I have way too much short Vega or not? Especially during low volatility regimes, we do not want to have too much short Vega. Okay, we have to be a little bit more careful there and keep it under 1%. Let's go through some live examples. So this is CL. This is crude oil futures. And back then, before the war that started around late February, March, we did a lot of strangles. As you can see, it was just pretty sideways. It was a downtrend, but it was pretty stable and we made a lot of money selling strangles for a very long time, okay? And I remember it started to go up because there was a war, okay? There's something going on. Now, it kept going up and suddenly we can see the IV had a spike here. So the top and bottom strikes were still relatively safe and unbreached. However, our strangles kept losing money because of Vega, because the IV kept increasing and it kept increasing our option pricing, so our short strangles were losing money. Another example of how Vega can work against us is a lot of people knew, okay, there's a war going on, why don't I sell some short puts to long the oil? And that's fine. So they sell something around here, and oil popped up from 65 all the way to 70. And even though it popped up 5 points, their options were not making money at all because the IV was so elevated, it actually canceled out the deltas. Okay, oil is a very weird instrument because when there's fear, the price of oil goes up. So IV increases when the instrument goes up. Most stocks, fear increases when it crashes. So in stocks and ETFs, for example, SPY, when it goes down, IV increases. The next thing I want to show you guys is, I want to show you guys how at the money contracts have higher Vega than out of the money or in the money. So let's take a look at this. 756, there's 70 Vega. You can see right here, 70. And if we go down in pricing, you can see it goes 63, 62, 55, 53. It keeps going down, okay? And if you go pretty deep enough, actually there's almost no Vega. There's 14 Vega here. And it's the same if you go up, okay, the put side. And this is both the put and call side, okay? So if you don't want to have too much Vega exposure, what does this mean? You want to sell stuff that are further out of the money, okay? The next thing is, I want to show you the time, the difference of Vega versus time. So 18 days, it's worth 70 cents. If we go out in time to 47 days, same strike, look at that. It's $1.10 in Vega, okay? If we go out in time again, let's go to around 60 days, $1.25. Okay, so the further out you go, the higher the Vega is. That's why when the IV is high and you want to benefit from an IV crush, you sell something that is further out in time. All right, that's it for this lesson. The key takeaway is you want short Vega exposure, but not too much in a low volatility regime. During a high volatility regime, you want to sell further dated contracts, especially when you're shorting premium. All right, traders, trade small, trade safe.